Hello, investors. August was a primarily negative month across most major world indices. Given the positive performance of some indices in the first half of this year, this was not all that surprising. International stock markets experienced a decline due to concerns resurfacing about the weakening Chinese real estate sector. Additionally, economic indicators from China, like retail sales growth, continue to disappoint, falling short of expectations. Emerging markets underperformed compared to their more developed counterparts. We'll touch more on this in our outlook. The Euro index fell as well in August, mainly due to pressure from the banking industry, where the Italian government declared a tax on bank surplus earnings. Central bank base rates and bond yields continued to rise, resulting in a decrease in bond prices. Higher rates for longer was a theme that was echoed across most major markets, and this was another factor in the negative performance of developed equity markets. As mentioned in our last month's commentary, the US government credit rating was downgraded one level by Fitch Ratings. This rating downgrade, as well as other factors, led to a rise in US Treasury yields during the month and increased bond market volatility. This volatility in the bond market prompted a sell-off in the stocks for the majority of the first 3 weeks of August, followed by a recovery in the final week. But it wasn't enough to finish the month positively. Overall, incoming economic data remained solid in the US. The labor market remained strong with payroll job gains slightly below expectations. Unemployment rose to 3.8% from 3.5%. Inflation in the US remained a concern, but there were some signs of improvement in that regard. Headline CPI increased slightly in July to 3.2%, but core CPI decelerated to 4.7%. The Federal Reserve remains concerned about inflation, and they left the door open for additional rate hikes if the data suggests it's necessary. In the UK, inflation data lagged behind the US and showed mixed results. Although headline inflation decreased to 6.8% in July, down from 7.3% in June, consumer prices remained at 6.9%. The Bank of England responded by raising the base rates from 5% to 5.25%, emphasizing the need for sustained restrictive measures to control inflation. Eurozone annual inflation was 5.3% for August, staying stable compared to July. However, core inflation, which strips out food and energy prices, fell. While the inflation picture is improving, it remains well above the European Central Bank's target of 2%, and markets are pricing in further ECB rate hikes before the end of the year to try to rectify this. The Eurozone economy grew by a modest 0.3% in the second quarter of 2023. But labor markets remain tight, with the unemployment rate falling to a record low of 6.4%. Clearly, the consistent message across markets is that persistent higher interest rates may be needed. The main global economic concerns seem to be centering around the strength of the Chinese economy at the moment. Economic activity in China was much weaker than expected. Consumer prices turned negative in July, falling by 0.3% year on year. Producer prices fell for the 10th month in a row. Retail sales missed expectations by a significant amount, and household confidence also remained weak. Making a rebound in the Chinese market seems unlikely in the coming months. Chinese investment data also highlighted low business confidence. The largest focus was on real estate, which was the weakest sector, with an 8.5% fall in investment between January and July compared to the same period last year. The difficulties of two of China's largest property developers also highlighted the ongoing issues surrounding the Chinese real estate credit market. To address these difficulties, as well as deflationary risks, the People's Bank of China lowered interest rates twice in August. However, credit demand remains weak, suggesting that these measures were not enough to improve the situation. We continued our tactical asset allocation strategy of being patient for market dips before increasing exposure to specific geographical equity sectors. In early August, we saw the S&P 500 and Nasdaq decrease by 4.8% and 6.7% respectively, and took this opportunity to increase our exposure to North America, specifically the tech-heavy Nasdaq index. Since the purchase of the Nasdaq, our only significant underweight position relative to our benchmarks is in the European equity market. Given the negative headwinds facing Europe for the remainder of the year, we fear an opportunity for us to increase our holding may present itself soon. We encourage you to contact your financial advisor should you have any immediate concerns. If you have any further questions for us, we of course welcome them and ask our clients to contact us on the email on the bottom of the screen. Thank you.